Good evening, everyone. Thanks for joining our monthly educational session. This month, our topic, as you know, is focused on investing in digital assets with a self-directed IRA. We have some special guests here with us tonight, Zach Resnick, who is managing partner, and Avery Walston, who is an analyst with Ezra New Economy Fund, and they're going to talk to you a little bit about the digital asset market, some industry trends, and then for anyone who's not as familiar with the self-directed IRA piece, if you're interested in using IRA for some related investments in the space, some of the ways that you can do that, as well as just some high-level concepts. So just a couple housekeeping things real quickly. I'm Brittany Piquel with Next Generation. You've probably heard my voice many times on these sessions. We are going to try to keep the webinar to an hour tonight out of respect for everyone's time. And we are going to also record the session. So if you happen to miss a piece of the webinar or you weren't able to attend live tonight, we will have a recording sent out to everyone who registered. If you are live with us tonight and questions come up during the session, feel free to enter them into the question box on the right side of your screen. We'll save a bit of time at the end to try to field those for you. And of course, if you think of any down the line afterward, feel free to reach out. We'll have our contact information available for everybody. So with that, I will let Zach and Avery get it started.
Thanks for the introduction, Brittany. And thanks for everyone listening in today. So first off, before we get into the fun stuff, legal disclaimers. So this webinar is not an offering. It's not intended to be an offering. We are not registered investment advisors. We are not giving financial advice. Any degree of investment comes with a high degree of risk. For kind of the full information on legal disclaimer, check out the slide that is pulled up right now. And without further ado, what is Bitcoin? So Bitcoin was the first blockchain and the first solution to what was called the Byzantine generals problem. So this was an issue in distributed computing and network of security, which was basically how can one trust a network without having to trust any individual? And this has been a problem that was trying to be solved for decades with no solution. And the short of it is Bitcoin was the first solution to this problem so that you can trust the Bitcoin network or trust any type of distributed ledger network without actually having to trust any of the individuals in the network. So instead of trusting individuals or institutions, you're trusting math and very strong economic incentives. So at what time did Bitcoin come to be? This was shortly after the financial crisis, when we saw quantitative easing and government printing currency at unprecedented rates. And that was kind of the origin. And now the way we like to think about it is, what is the economic value of a data ledger that you can trust 100% of the time? This is what comes from both Bitcoin and blockchain. What the true value that will be unlocked over the long run is yet to be seen. And I would think about blockchain in the same way we think about the internet, which is it's a fundamental technology that is already changing and will continue to change every industry and the way that we transfer value and information around the world. So I'll now leave it to Avery to talk a little bit more about how the technology actually works.
Blockchain is one type of distributed ledger technology. There are various distributed ledger technologies, but blockchain is definitely the most prominent. It's the distributed ledger technology underpinning the Bitcoin network. So what this does is, if I want to perform a transaction, the transaction is represented in a block, which is mined by a miner who is incentivized by block rewards in the form of Bitcoin. And once the miner mines this block, it is then propagated throughout the network to all the nodes which keep a record of the ledger. And by doing this, they create an immutable transaction history which can't be changed retroactively. And that's how distributed ledger technology works. Intro to Bitcoin and blockchain. Basically, the Bitcoin system uses a consensus mechanism referred to as proof of work, which was employed to solve the double spin problem, as Zach mentioned. Some of the notable qualities of blockchains include decentralization, retroactive immutability, censorship resistance, and transparency. What do these mean? Well, decentralization is essentially the quality of something that is distributed and essentially controlled by nobody. There's no central authority. There's no single point of attack, which is really the main quality of decentralization. Retroactive immutability, this basically means that the ledger is tamper-proof, and they achieve this because every node is holding a copy of the ledger. And if a node tries to submit a competing copy, all the other nodes already know, hey, that's invalid. That transaction is untrue. As far as censorship resistance goes, this has to do with the decentralization of the network. There's no single authority. There's no one person who controls the network, and therefore nobody has the ability to censor the chain. And as far as transparency goes, transparency is a result of triple entry accounting, which was as opposed to traditional accounting, when you typically credit a seller and debit a buyer. Triple entry accounting adds a third entry, which is a receipt, basically including information about the transaction that it happened. And by doing this in a decentralized, distributed way, we're able to create that retroactive immutability and that censorship resistance, essentially.
Okay, thanks, Avery. So on kind of to the investing side of things. So hopefully that summary has piqued your interest as to why, blockchain, why Bitcoin and other crypto assets might be good investments. And, if you're listening to this webinar, you've taken, of course, some level of action and interest in the asset class. So indexing in equity markets, as I'm sure most of you know, has significantly outperformed active management. And there are very, very few active managers that are managing equity and bond portfolios that are able to, over the long run, outperform passive index funds after fees. These markets are mature, they're regulated. We've had Enron, we've had some notable fraudulent companies, but the risk is fairly minimal. And there's a level of efficiency with the billions of dollars that have poured into some of the top active managers trying to find inefficiencies in the market, such that there aren't a large amount of inefficiencies to exploit the way there are in kind of newer emerging markets, such as the crypto asset marketplace. Within the crypto asset marketplace, this is a market that is overwhelmingly unregulated. We're starting to see recently some SEC action, but overall, on the spectrum of a regulated to unregulated market, there's very little regulation, both domestically and especially internationally. And then regarding the efficiency of this market, the liquidity for almost all but the top assets is very low, such that there are significant volatility. And even for the asset with the most liquidity, BTC, one of the main versions of Bitcoin, you're still seeing a lot of volatility. And from that volatility and from the asymmetric information that happens in this market as opposed to an equity or bond market, you're going to see a lot more opportunity for active managers to be able to have alpha against that market. One example, if you see the logo of BitConnect, this was really nothing more than a Ponzi scheme that many in the space, including myself, kind of identified many months before it came out. for anyone interested in, a laugh and to learn a little bit more about kind of this scam, I recommend checking out BitConnect and searching that on Google or YouTube. But this type of just blatant Ponzi scheme, being allowed to ascend to a over $1 billion market cap, that just wouldn't happen in a traditional market. And if you were using an indexing strategy of taking the top 10 assets or top 20 assets, you would have had significant exposure to what I think any competent active manager would correctly identify as a Ponzi scheme. So I think in the long run, as markets become more efficient, indexing can be a great strategy for long-term oriented investors, but I don't think we're near that place right now in the crypto markets. So kind of as an example of that, our fund's return this year compared to the Bloomberg Galaxy Index. The Bloomberg Galaxy Index is a weighted index that comprises some of only the top crypto assets. And while there's no blatant Ponzi schemes or scams in that, there are certain assets that we feel are incredibly unlikely to hold value in the long run, but just because many people think they do right now, they're in kind of the top assets. So following an index approach would give one exposure to that. And to date, both our fund and other actively managed funds have, in my anecdotal experience with other funds, often significantly outperformed indexes as well. So kind of talking about passive versus active, with passive portfolio management, one of the benefits for equity markets is you don't have the high cost associated with trying to take advantage of market cycles. Of course, there are always active managers that are able to call these market cycles and profit from it, but doing so over the long period of time and consistently is very difficult. In addition, those type of cycles occur within an emerging market like crypto, where people are speculating nonstop, much faster than in global equity markets. So we've already seen in Bitcoin's 10-year history at least 3 major market cycles, where in global markets we've seen arguably just one. So also to clarify, I know a lot of you are listening specifically for the purpose of seeking to invest in digital assets via self-directed IRA. When I'm talking about passive versus active here, I'm talking about management and not investing via the IRA. So both of these options would be a passive investment strategy. As when I'm referring to active portfolio management, referring to allocating capital to portfolio managers and active investors, like myself and like the New Economy Fund, not suggesting to actively manage one's portfolio by themselves. A lot of people actually ask me, hey, you're going all in the crypto and blockchain space. I'd like to invest. How should I do it? And for those that aren't accredited investors and aren't looking to invest a lot, it's really difficult for me to say, because some of the assets that I thought might be great investments as recently as a year ago, things have just changed so fast that I wouldn't want to recommend to anyone try to manage a portfolio unless they have the right type of experience and skills and are really doing it full time. So I myself am doing diligence on our existing portfolio assets, potential companies to invest in, and just on the broader market constantly, just to make sure that our portfolio performance stays as strong as it has done to date. There's been several opportunities to take advantage of information that comes out publicly but isn't priced in for days later. This type of thing doesn't really happen in equities markets, but one has to be plugged into all the right semi-private and public information feeds to take advantage of this. And if let's say you just make an investment into BTC or Bitcoin and you're not dedicated to doing this, there could be some opportunities that don't really exist in equity or bond markets, but that happen at least a few times a year to date, at least in the crypto markets. And there's no opportunity to, take advantage if you're not reading and seeing these things. And then lastly, the issue with passive investing into crypto asset marketplace is one could actually be then holding coins or assets that with crypto assets deemed illegal by major
Jack, I think we're losing you a little bit.
Risk to passive.
You're breaking up.
Oh, yeah. Sorry about that. When are we back now?
Yes, you're good now. I think we only lost you for about 10 seconds there, so you're fine.
Oh, great. Okay. So the last point I was making was just that the last risk to passive investing is I think there's a very real risk that the vast majority of passive portfolios could have exposure to assets deemed illegal by the US government over the coming years, where that's something that an active manager is constantly, staying on top of and learning about. So that's kind of my last point there. I will now leave it to Avery for the next slide. If we can get that slide
one more
up.
time.
Great.
Okay, so blockchain, digital assets, and the internet. Obviously, there's some similarities here. The first one to cover is that obviously they were both grossly misunderstood in the earliest days. The internet in 1994, before Netscape, nobody really understood the potential of it or how disruptive it could be. And that's kind of where blockchain is now. I mean, people are starting to kind of get it, but we're still in the very early innings of blockchain and Bitcoin and digital assets as a whole. And part of the reason that it's rejected and, people like Warren Buffett and traditional value investors don't see the value is just because it's so complicated and it oftentimes sounds like some techno babble or crazy tech talk that most people just have a difficult time understanding. So it's understandable that it's undervalued or people aren't able to perceive how disruptive this technology can be early on. And that's understandable, but I mean, if you can be on top of it, obviously you're in a place that has a lot of room for growth, as you can see with the internet. So for the next similarity, essentially when you're dealing with markets like this that are, for the most part, relatively misunderstood, and you have assets that are fairly liquid that people are able to trade with a very, very relatively low barrier of entry, you get market cycles and you get behavioral economics. I mean, I think this is a Charlie Munger quote, if I remember correctly, but what is economics if it's not behavioral? That's just fundamentally something that every market is going to experience, some markets more so than others. And part of the reason that the market is so, or that these behavioral economics play such a huge role in crypto markets is because of the irrationality. In part, a lot of the people investing in crypto aren't necessarily working at funds. There's not a ton of resources like there is in the stock or bond markets being thrown towards researching these assets and creating efficient markets. So these inefficiencies really create these market cycles. And again, that's another thing to be taken advantage of. Anyway, here's a quote from Pel Brandgard. Quote, me in 1994 explaining my fascination with the internet to people. The internet is a way of transmitting data that routes around censorship. It does this by taking data, splitting it into packets, and sending them from one node to the next until they reach their final destination and assemble themselves again. It's so cool. Well, that may be cool to somebody with a good high-level understanding of how these things work and the implications of them, but to the majority of people, that just sounds like some techno babble. And then for comparison, Pel said, me explaining my fascination with Bitcoin in 2013. Bitcoin is a way of sending money from anyone to anyone without censorship or gatekeepers. It does this by you holding a private key that transmits a transaction onto a peer-to-peer network where thousands of computers compete to cryptographically include it in a block of transactions trusted by everyone else on the network. Still sounds a little difficult to understand, kind of similar to how his explanation of the internet was. Next up, Bitcoin and digital assets as a whole have been historically quickly adopted. There's clearly a reason for this. That doesn't just happen. The reason is that Bitcoin and other digital assets have various advantages over traditional fiat currency. To touch on some of those advantages, one, Bitcoin is peer-to-peer. Like we discussed earlier, no one is able to censor the network. There is no central authority or intermediary. You are transacting with other peers, and you are sending your funds directly to peers without a central intermediary. That helps give value to users on both ends or both sides of the transaction because, again, there's no central intermediary to take a cut. So next, the next advantage is that Bitcoin and digital assets are digitally transferable. That is a thing for fiat currency nowadays, but you have to use clearinghouses and other companies and intermediaries that take a cut. So this digital transferability is an advantage. Bitcoin is also highly divisible, up to 8 decimal places. So it is seamlessly divisible and able to be sent from one person to another. It's able to be used for micropayments, etc. Bitcoin is also truly scarce, meaning that there's 21 million that will ever be mined, and that creates true scarcity. The transaction history, as we covered earlier, is transparent and immutable, meaning people cannot tamper with the ledger retroactively.
Thanks, Avery. Now into some of our last slides. So, yeah, I think this sentence says it all. Bitcoin and digital assets are the fastest growing asset class in history. So this right here is a graph of BTC, the main implementation of Bitcoin's price. If one invested $10,000 when Bitcoin came out, they would be a billionaire by now. Of course, it is very unlikely to see that high level of returns in the future. But with the analogy that we were saying before of how this is a fundamental technology like the internet, venture capital and investing in early stage technology companies only made possible because the internet has had a beta significantly higher than the S&P 500, Dow Jones, global equity, and global bond markets. Sometimes there are asset classes that just have a significantly higher beta than others, and this is most true in the early stages. So one might think, oh, well, there's hundreds of billions of dollars already in it. Can it continue to grow? That is debatable. Of course, I wouldn't be here where I am right now if I didn't think the answer was yes. And the expected value, in our view, of not just Bitcoin in general, but digital assets as a whole, is much higher than any other liquid asset class that's available to invest in today. So you might be thinking, okay, might have a high expected value, but the volatility is very high and the risk is very high. Because of the really low correlation and at times negative correlation between Bitcoin and the S&P 500, as long as you take as a given that this asset will either stay the same in value or go up in value over any period of time, modern portfolio theory would say your portfolio actually becomes less risky by holding this asset, even if it's the asset or an asset class that has significantly higher volatility than the rest of one's portfolio. So lastly, we're going to end with kind of the two sub-asset classes that at the New Economy Fund we feel are the kind of highest value, most fruitful asset classes looking into, and the only things that we invest into. So first off, digital sound money. So these are types of cryptocurrencies that are effectively competing with government currencies. Some examples of those include Bitcoin, Beam, Monero, Zencash. There's many of them, although there's very few that we feel like are going to be good investments and likely stay in the long run. And we feel that by competing in the world of what is money, that's the world's largest asset class in terms of where value is currently being locked up. So the return profile is the highest, even higher than any kind of early stage technology company to unicorn, given there's over $50 trillion currently stored in currencies worldwide. And I'm sorry, it's the second largest after real estate, not the largest. And then the other kind of sub-asset class within the crypto space are distributed marketplaces. So the way we think about these are marketplaces that have a competitive advantage because of blockchain or weren't possible beforehand. So Uber, Airbnb, these are distributed to some degree, but they're not fully distributed in that you have to trust the company of Uber, the company of Airbnb to use these services. Truly distributed marketplaces require trust of no one besides math and strong economic incentives. That being said, there are also some hybrid marketplaces where there's some degree of trust to a counterparty or institution, but have less amounts of trust required than other solutions now. And because of that distribution, are able to deliver better service to their customers and often do so much more cheaply than comparative services or companies that are not using blockchain. So thank you for your time and listening, and looking forward to answering any questions you have today.
Thank you both, Zach and Avery, for your expertise. I know that even from our perspective, just the topic of cryptocurrency and digital assets in general has been one of great interest for many, and I think a lot of us that aren't as educated as you clearly are, see that we hear a lot of buzz about it. There's a lot of talk about it, but we don't fully really understand it and have an appreciation for it. So I think that what you just went through helped us gain a bit more of that and better understand what's involved, and perhaps be more informed in terms of making decisions related to those types of investments. So I'm just going to talk tonight about the self-directed IRA component to all this. Of course, if you were to invest in digital assets with your personal funds, you wouldn't need the information I'm about to share with you. But if you are interested in gaining some tax advantages on your investment return and hedging against some of that stock market volatility, some of which Zach referenced, this may be something that you'd like to learn and be interested in as it relates to either digital asset investments or many other types of alternative investments. So just quickly, Next Generation as a company is not a bank or a financial planning service or brokerage house. We are custodians and administrators for self-directed IRAs specifically. So it is a niche that we have focused on for the past 15 years. And our job is really to be more of a neutral third party in helping to guide investors through the account setup and investment process, and to provide education like we are tonight related to different investment options, as well as guidelines for making investments within IRS rules and regulations. Also, a disclaimer from our end, as I mentioned, since we're not financial planners or advisors, we're not fiduciaries, and so we don't have the ability to recommend or endorse specific investments. All the information is for educational purposes only, especially with self-directed IRAs and retirement plans. It's critical that investors do their due diligence on their own investments. You have, of course, the ability to control your own investments and make your own decisions, but you do need to be comfortable and confident in those decisions, and you as Zach mentioned, you do assume the risk associated with those decisions. So just a bit about the company. As I mentioned, we've been in business for 15 years. We are a women-owned business located in New Jersey. Our founder and CEO, she has quite a bit of real estate investing experience, which is how she came to found the company, out of a desire to put some of those real estate investments in a retirement account. So at this point, we are managing about $600 million in assets, a little over 2,000 accounts, and we are a trust company, which enables us to act as custodian for these accounts as well. Just real quick, we have two sister companies, one being the trust company I mentioned, which acts as the custodian to hold the retirement accounts. We do the tax reporting and the record keeping on all of the plans and their assets. And then the next generation services arm, which is the office located in New Jersey, is the administrator that provides all the customer service, client-facing service, and account management, and helps to process all the investment transactions from purchase to sale, paying income and expenses associated with investments out of these self-directed IRAs. So what actually is a self-directed IRA? Because the term does get thrown around a bit loosely and it can mean different things to different institutions. When we say self-directed, we mean truly self-directed in that you are able to open up your allowable investments beyond publicly traded assets. So it's not a brokerage account. You're allowed to invest in just about anything that's not publicly traded, with a few exceptions. And what's beautiful about that is that you have the ability to have more control over your return on investment. And if you have specific investments that you're very excited about or interested in, perhaps experienced in already with your personal funds, or you're passionate about a specific topic or cause that's not something related to the market, you have the ability to apply these investments to your own retirement account, which is obviously another option to help grow financial wealth for your own future. And of course, those returns that you earn keep your funds tax advantaged or tax free, depending on what type of account you have. And as I mentioned earlier, the ability to hedge against volatility in the market by holding assets that that are not going to tend to mirror that sort of activity. So why is this important? We're seeing that there is an increased proportion of the population in the labor force. Individuals age 65 who are working have doubled. And as you can see here, participation rate in the labor force has cracked the 20% mark. So why do we think this is? Well, there are probably a lot of reasons for it, but we know that Social Security is diminishing. We know that it's hard to come by the types of pension plans that were typically offered by employers back in the day. Typically now all we really have are 401k plans, and when we leave a company, we have to take them with us. Otherwise, they don't really do anything. So the resources that we have for retirement planning and financial wealth building are different today than they used to be. On top of that, we're seeing growth in the alternative asset market in general. So even advisors have indicated that they'll be increasing their investors' allocations to alternatives in the future. Most of them by up to 25%, which is pretty significant. And you can see that the area primarily of focus are private equity, lending, and real estate here. PwC predicts that alternative assets will increase to 15 trillion by 2020, which is not far away at this point. So back to self-directed plans, now that we kind of understand the landscape and really what they are, types of plans that you can establish to self-direct are the traditional IRA for tax-deferred investing, the Roth, which allows you to use after-tax dollars and grow your funds tax-free. SEP, simples, and employer qualified plans are available for business owners. And then the Coverdell and health savings accounts are for education and medical expenses. And a lot of people don't know that those can actually be self-directed as well. They come with many tax advantages if you withdraw those funds for their purposes. Ways to get funds into a self-directed IRA. You can make a personal contribution by depositing out-of-pocket funds into the account. Of course, those have to be in line with IRS annual contribution limits, and those vary depending on the type of account you have. You can always check the IRS website if you're not sure. You can do a transfer from an existing IRA that you might have in a brokerage account invested in other securities. If you wanted to liquidate a portion or all of that existing account, you can transfer that cash from IRA to IRA and get funds into your self-directed account. You can also, as I mentioned earlier, roll over from an old employer plan like a 401k or a 403b that's no longer active and not performing or being managed. You can use those funds to roll them into a self-directed IRA. And if you're moving funds from a tax-deferred to a Roth account, it's considered a conversion, and that's also possible with the self-directed IRA as well. So possible investments, real estate is really the biggest. Of course, today we're talking about cryptocurrencies, notes, private placements, limited partnerships, private stock, international real estate, hedge funds, precious metals. There are many, many things that you can invest in, with the exception of course, you can see here, life insurance and collectibles. So as long as the asset class you're looking at does not fall into life insurance and collectibles, it is fair game to consider for a self-directed IRA. So today what we're focused on from kind of a way to use the IRA, and what we've covered with Zach and Avery is the ability to invest into a fund. And now I know we talked about active versus passive. When I say passive, I'm not referring to how the fund is managed or not managed, but rather than using your IRA to directly purchase these cryptocurrencies, which if anyone holds them today, you know sort of how that can work. And I myself have some Litecoin and some other things I've purchased using a digital wallet. But if you want to use your IRA and you're not looking to kind of actively be managing the day-to-day oversight and trading involved with each of these different currencies, then you have the ability to invest into a fund that, like as Renew Economy Fund, that is holding various currencies. So one way that you can do this is through a private placement using the IRA. So typically the fund will be structured as a C corporation or an LLC. You can use your IRA to purchase shares or invest directly as a limited partner, receive some sort of equity, and then from an investment return standpoint, you're paid back from the fund directly into your IRA. And that's how your IRA would earn its return on investment without really having to do very much other than send the funds from your IRA into the investment. One thing to note, and this isn't really as applicable to investing in like a larger fund, because typically if you're investing in a larger fund, it's not your own fund. You're not managing it. The others invested in the fund are probably not people that you know, and your share would probably be minority. But one thing to know is that you do want to be aware of what the IRS considers disqualified person. These are the people and entities with which your IRA is not permitted to directly transact or benefit from its investment. So as you can see here, primarily it'll be yourself and family members, which are essentially your ascendants, descendants, and their spouses. There are certain family members that don't fall into that category, but the majority of them, as you can imagine, do. And that would just mean that your IRA cannot purchase anything, sell anything to, lend to them or borrow from them directly. So you can't enter into any investments that on the other side involve these people. If you were to do something of that sort, the consequences can be severe. The IRA, if it can't be corrected with the help of an attorney, would be distributed back to you as if you took a full withdrawal of the account, and those would be subject to applicable back taxes, other types of fees and penalties as well. So it can really add up if the prohibited transaction took place in prior years and the IRS doesn't identify it, until later. So one way to mitigate this risk is to just be as educated as possible on the regulations surrounding what you can and cannot do. Of course, the custodian of your account should be that educational resource to provide you with what you need. However, they cannot guarantee that you will not commit a prohibited transaction, because when you have a self-directed IRA, you're making a lot of decisions and you're making a lot of determinations about how you manage your investments. You need to be aware and take ownership of being sure that you understand the regulations. But if there were ever a time you weren't sure of something, you could call the custodian before making a decision to go over it with them and to check with them. Now, as it relates to private placements, which we're sort of talking about tonight as far as investing into a fund, a couple examples of a prohibited transaction or what you cannot do is invest your IRA into a company or a fund majority owned by disqualified people. So if you were looking to use a self-directed IRA and invest into a fund that was owned by your father, for example, 100%, that would be a prohibited transaction. If the fund was owned 50% by your mother and your father, that would still be a prohibited transaction, because your mother and your father are both disqualified people, and if their ownership combined came to 50% or more, that would of course fall into this rule here. The other thing to note is that if you are investing into a fund with your IRA, you cannot personally be an active partner, a director, or a managing member of the entity. So the investment in nature has to be passive. You want to be hands off as far as managing that, and you don't want to be compensating yourself personally for any services if your IRA is invested. And as I mentioned earlier, any earnings or dividends cannot be paid directly back to the owner of the IRA personally. So anything that your IRA buys or invests in, if it yields a return, goes directly back into your retirement account, and that's for the purpose of maintaining its tax advantage status. So if you were to send it back to yourself directly, it'd create a taxable event. Of course, you are entitled to the funds because they're your IRA funds, but if you wanted to take them out through the proper channels of taking a distribution out of your IRA, the funds would still go back to your IRA first, and then you would take a qualified distribution from there. That would be reported properly to the IRS. So in terms of opening an account and making an investment, we get this question a lot: how long does it take? I usually say the most conservative timeline would be 4 to 6 weeks from getting an account open to getting it funded to getting the investment done and funds sent to the investment. As you can see, opening a new account is a very straightforward process by completing an application, and it's done in 1 to 2 business days. But the funding part can take some time because the second step in the process is using one or more of the options I mentioned earlier to get funds into your new account. So that was either making a contribution, transferring from another IRA, or rolling over from another old employer plan. And as you can imagine, working with another institution to get your funds out of their custody is usually not something that they're willing to expedite for you. So we do help facilitate that process and getting funds moved out of your existing account or accounts into the new account. But of course, there may be delays associated with processing times on the other end. And then making an investment, the reason that we say 1 to 2 weeks is just because there is a compliance review that we conduct. And that involves looking at any supporting documents associated with the investment, to be sure that it's something that's feasible for us to hold and we don't see any red flags or risk of a prohibited transaction prior to processing it, and that the IRA is named appropriately in all the documentation so that we have accurate information and accurate reporting, and that's really important for tax purposes. So we do conduct a thorough review of all the documents before going ahead and processing the transaction. So with that, I wanted to keep this part relatively short tonight because I know that we've gone over this. For anyone who's been in prior sessions with us, but we always do have some newcomers and beginners in the self-directed IRA space. So I want to make sure that we go over some of the high-level concepts as well. But if this is something you'd like to learn more about, as far as the digital asset market just in general, or using your self-directed IRA in general, or doing both, definitely reach out and contact us. Zach and Avery, we will have your contact information available as a follow-up as well. And of course, we may reach out to you all just to get some feedback on the webinar or see if you have any questions. So with that, I'm going to stop and see if we have any questions on the live session tonight. It doesn't look like we do. Let me just double check. I see a hand is raised, but I'm not sure if that's to ask a question. So let me give him a moment. If you do have a question to the person who raised their hand, if you do have a question, please enter it into the question box so we can read it for you. Okay. I don't think the intention was to type a question. Yeah, I don't see anything. Okay, no worries. We, as I mentioned earlier, will have a recording of the webinar provided to everyone. Zach and Avery, do you have any closing comments?
No, just thank you for everyone came and listened and who's listening to this after the fact. Feel free to get in contact with us when this video will be posted. I'm sure Next Generation Trust will put the New Economy Fund contact information there. I personally have a reading list that I recommend in terms of just additional resources to learn about the space. We have a podcast where we kind of discuss a little more granularly some of the ways we think about our investing decisions. And for anything at all, anyone interested in learning more, feel free to get in touch, and thanks for listening.
Thanks so much, guys. Appreciate your time tonight. Take care.
Bye.